Okay, so let's move on into the analysis of each single Greek letter. Lesson 23, the delta of an option. Here, what you will learn here, what is the delta, what is the meaning of the delta, an in-depth analysis of the delta and how delta can be used for hedging purposes. The delta of an option measures the reactivity of the price of the option as the price of the underlying changes. It's something we have already seen, if you remember, in lesson 11, but in that case, we measure the change in the price of options in front of a 500 points price change in the underlying. So basically, we calculated the deltas of those options, but to be stringent, it was an approximation. Being the delta a derivative of the price curve, indeed, its current calculation demands for an infinitesimal change in the independent variable, the spot price. And 500 points is not at all an infinitesimal change. So once again, it was an approximation. The precise delta of a European call written on a stock that does not pay dividends is expressed by the value of the parameter n of D1, which is part of the calculation of the price according to the Black-Scholes model, if you remember. Later on, I will show you how to put the Black-Scholes formula in an Excel spreadsheet and how delta can be calculated. The delta of a European put written on the same security that does not pay dividends is given by the n of D1 minus 1. Virtually, then the sum of the two deltas, the delta of the call and the delta of the put, in absolute value should make the unit in absolute value because the delta of the put is negative. However, there is a clarification to be made. Delta of calls and delta of puts together make the unit only when the two options have the same implied volatility. Since this is generally not the case, it is clearly seen from the skew of implied volatility seen before, then the delta of the put must be determined on the basis of the delta that the call would have if it had the same volatility as that of the put. Let's look now at an Excel spreadsheet in order to fix all these concepts. Okay, here we go. In this Excel spreadsheet, I created all the fields for the calculation of the options price according to the Black-Scholes formula. I also included the possibility to have dividends, even if I know that the calculation would not be totally coherent and correct. So it was just a way to have a rough idea of what the price of an option could be, even in case of dividends. Anyway, let's ignore the part about dividends and focus on the regular use of, let's call it the regular use of the Black-Scholes formula. So we have the spot price, the strike price, the risk-free interest rate, the implied volatility, the day of the calculation, the expiry date, and then the residual life and the residual life on a yearly basis are automatically calculated by the spreadsheet. So the cells we have to put arbitrary values in are those with the yellow background. So let's take the case of a spot worth 100 euros or dollars, it doesn't matter. Strike price the same, so we are evaluating a call and a put at the money. Let's take 1% risk-free interest rate and a 20% implied volatility. Date of the calculation today, expiry date January the 20th, 2020. The call price, the theoretical call price is 296. The theoretical put price is 283. As you can see here, the two parameters D1 and D2 have been calculated. You see the formula is quite complicated, but it's exactly the formula you can find in the presentation. D2 is D1 minus sigma implied volatility times the square root of time, that is time power to 0.5. The square root is the same as powering to 0.5. So the normal distribution of D1 is this, the normal distribution of D2 is this, And then the normal of minus D1 is 1 minus the normal of D1. The normal of minus D2 is 1 minus the normal of D2. N of D1, as written in the presentation, is the delta of the call. Of the call 100, when the underlying is 100, the risk-free interest rate is 1%, the implied volatility is 20%, and we have 48 days of residual life. What about the delta of the put? The delta of the put is N of D1 minus 1, that is this minus 1, minus 0.4783, and minus N of minus D1, basically. This would be the delta of the put only if the put had the same implied volatility of the call. And the same applies for the price, because the put price is 283 only if the implied volatility of the put is the same as that of the call. If this is not the case, and we assume that the price of the call is 296 because the volatility of the call is 20%, if, just to say, the implied volatility of the put is 22%, then the theoretical put price is 311, not 283, and the delta of the put is not minus 0.4783, it is minus 0.4775. So it is the minus N of minus D1 we would achieve if the call had the implied volatility equal to 22%. Otherwise, being 20% the volatility of the call, this is the delta of the call. But this is not the delta of the put, because the put has a different implied volatility values, let's say 22%. So how do we get to the delta of the put? We calculate the delta of the call as if the call had an implied volatility equal to 22%. And then we calculate the delta of the put as the complementary to minus 1 of the delta of the call. And that's it. Interpretation of the delta. The delta of a call varies between 0 and 1 or between 0 and 100%. It's the rate of replication of the price change in the underlying, remember. That of a put ranges between minus 1 and 0 or between minus 100% and 0. This happens because if you look what happens if the price of the underlying increases, in case of puts, you have that the numerator of the fraction, what happens to the spot, is an increase. What you have in the denominator is a decrease, so it's a negative variation. So a positive divided by a negative leads to a negative value, and that's why the delta of a put is negative. The delta of an option gives room to an interesting reading, which represents the mathematical assumption of a price risk hedging strategy called delta hedging, which we will see later on in this lesson. Expressed in percentage terms, in fact, it can be seen as a measure of the probability of an option to be in the money at maturity. Let's go through this again. A measure of the probability of an option to be in the money at maturity. The options having delta 0.50, therefore, typically those at the money, with some approximation, are options that have about 50% probability of expiring without any value and equally of expiring with a positive value. But pay attention, because this does not mean to earn, because in order to earn money purchasing a call, you do not only need it to reach the strike, you need it to reach at least the break-even point. So it's only beyond the break-even that a profit is obtained, not beyond the strike. Selling short an option having delta 0.20 then, at least theoretically, means selling an event with a probability of success of 20% to someone else. And if on the one end the buyer has a 20% chance of earning, then on the other the short seller has 80% of probabilities to win. The delta is in a sense a measure of the instantaneous speed of the option price. It tells us how fast it moves in the same direction as the underlying. The next slide shows the graphical trend of the delta of the call and put strike 22,000 on the FTSE MIB index in the absence of dividends when the risk-free interest rate is 0.01%, the implied volatility is 25%, and the residual life is 60 days for different price levels of the underlying. Let's move on to the chart. Here, sorry for the Italian, but I couldn't change it because this is an image. So this is the delta of the call and the put strike 22,000 points on the FTSE MIB index in front of different values of the underlying, given a risk-free interest rate 0.01, a residual life 60 days, and implied volatility 25%, no dividends. Let's see this later. Let's look at the chart. On the x-axis, we have the values of the underlying. The strike is fixed, 22,000 points. So what happens to the call 22,000 points when the spot price is 15,000? The call is deep out of the money. We are in 15,000 points. We needed to reach 22,000 points just to get to the strike. So the reactivity of the option is very close to zero. No matter what happens to the spot price, the price of the option will change will have a very little change. What happens if the underlying increases and gets close to the strike? The delta starts increasing, and it increases more and more and more and more and more as long as we get close to the strike price. When we get to the strike price, the delta is more or less equal to 50%. It's not exactly 50% because it depends on specific situations. And what happens if in the moment that the option becomes in the money, we get into the right-hand side of the chart? It happens that the delta of the option keeps increasing, but at a lower rate of change than it did before getting to the at the money levels. Why is that? Because it cannot continue growing up constantly. Sooner or later, it will have to asymptotically converge to the maximum possible value, 1 or 100%. So what happens is that, mathematically speaking, in the ATM strike, there is an inflection point. Here, the price of the delta of the option increases with a shape similar to the exponential function. After the ATM strike, it increases something more like to the logarithm, to the logarithmic curve. So what is the delta? Delta is how much the price of the option increases or decreases in front of a 1-point change in the price of the underlying. This is the manual definition of delta. Let's now look at the chart of the delta of a put. We still have put 22,000. This is the underlying. If the underlying is much higher than the strike, this time the option is out of the money. So the call is out of the money when the underlying is below the strike. The put is out of the money when the underlying is above the strike. So for 29,000 points of the underlying, the put 22,000 is deep out of the money. Its delta is 0. Then, the more the price reduces, the more the delta increases in absolute value, because remember, the delta of a put is negative. So it goes down and down and down and down. It reaches about minus 0.50 when the option is at the money, and then it changes the slope of the curve from increasing delta to decreasing delta. Decreasing in relative terms, the vertical difference between two consecutive values of the delta, and it asymptotically converges to minus 1, the maximum potential negative value of the delta. How much do the initial conditions matter? A doubt that may arise is whether the shape of the delta curve is a constant or whether it is not affected more or less markedly by the boundary parameters. In essence, the doubt is the one already highlighted in the introductory paragraphs on the Greeks. Can the impact on the price of an option of a change in only one of the parameters be evaluated, when all the others are kept still? In this regard, it is rather interesting to study how the shape of the delta curve changes when the conditions of implied volatility, interest rate, and residual life are significantly different from those used for the construction of the charts on the previous slide. In the next slides, we will see how the shape of the delta curve changes for different values of the other variables. The aim is to point out that on longer maturities, the delta dynamics are generally much more linear than on short, medium-term time horizons, rather than when the maturity is very close. Similarly, we intend to investigate how high volatility or low volatility may have an impact on the responsiveness of the options to the underlying. And finally, how much the risk-free interest rates may affect. We will focus only on calls, not for particular reasons, but only because they are easier to visualize. With just one graph per page, we can see the dynamics of curve changes better. Delta chart with respect to the volatility. Once again, sorry for the Italian. This is the chart of the delta in respect to the volatility of a call strike 22,000 points on the FTSE index, given a risk-free interest rate 0.01, residual life 60 days, no dividends, implied volatility ranging between 10 and 30%. You see three different curves according to three different implied volatility values. When the volatility is very low, the curve of the delta is much more concentrated on the ATM strike. This means that in periods of very low volatility, options do not react unless the price of the underlying gets very close to the strike. And soon afterward, the strike of the option has been crossed, the delta very fastly converges to the maximum potential value. If the implied volatility is much higher, 30% instead of 10, we have the yellow curve. And the yellow curve tells another story, because in such a situation, the reactivity of the option is not very high, but still significant, even when we are out of the money, something that absolutely doesn't happen if the implied volatility is very low. And this is the proof that it is very hard to isolate the effect of one variable, keeping all the other fixed. But we will see plenty of other examples in order to prove this. Graph of the delta with respect to the residual life. Chart of the delta in respect with the residual life of a call, strike 22,000 points on the FTSE index, risk-free interest rate 0.01%, residual life ranging from 5 to 365 days, no dividends, implied volatility fixed, this time to 25%. If the residual life is very short, just 5 days, the delta of an option has the same trend as it happens in low volatility situations. You see that? Why is that? Because the shorter the time to maturity, the lower the probability to reach the target. And this means that if we are out of the money, the reactivity of the option is zero. We have to get very close to the strike in order to see the delta change significantly. If the residual life is quite long, let's say a calendar year, what happens is that the shape of the delta becomes almost linear. And this, once again, is the proof that you can hardly isolate the effect of one parameter, keeping all the others fixed. Because depending on different conditions in the market, you will have something very different from what you can expect. Delta chart with respect to the risk-free rate, it's the proof that the risk-free interest rate is not of any importance. This is the graph of the delta in respect with the risk-free interest rate of a call strike 22,000 points with a variable risk-free interest rate ranging between 0.01% and 5%, residual life 60 days, no dividends, implied volatility 25%. You see, no matter the interest rate, more or less, the shape of the delta is always the same. So we can basically ignore the risk-free interest rate, also for other reasons which we will see in one of the next lessons. Considerations on the delta. The study in the previous slides allowed us to establish some important results. First, the risk-free rate has no particular impact on the shape of the delta curve. On the other hand, as we shall see, it can have a significant impact on option prices, although there are some clarifications to be made in this regard, and we will do them in due course. Second, the residual life plays instead a decisive role in the study of the trend of the strategies in options. In particular, the passage of time involves a gradual crashing of the delta curve on the option strike. At maturity, in particular, the delta of a call can be worth only 0 or 1, so the curve is reduced to a binary broken line. On long deadlines, moreover, it is interesting to note how the delta moves almost linearly, as if moneyness did not influence the rate of growth or decline of the delta itself. Third, the implied volatility in turn plays an important role. The greater its value, in fact, the softer the delta curve. Vice versa, in situations of flattening volatility, out-of-the-money options do not react. In the money immediately go to maximize the replication of the movement of the underlying. Delta immediately converges to 1. Fourth, since the delta changes shape, even in a sensitive way, when the volatility changes, it is not infrequent that an operation initially endowed with a certain probability of success, the delta known at the time of entering into position, is found to have this probability significantly changed due to a change in the market. And since the volatility does not change without a price movement that can justify the perception of a greater risk, if the underlying moves against the assumed position and the volatility increases, the problem is amplified, and this is a typical problem of short puts. You short sell a put, the underlying moves against you, the implied volatility increases. So you have 2 times the market against you in the same moment. Static and dynamic hedging. As mentioned above, the delta of an option can be interpreted as the probability of that option to be in the money at maturity. In this sense, the delta is a measure of probability of profit for the buyer or loss for the short seller. Now, the management of a long strategy cannot be done in many ways. We assume to buy a call against a bullish expectation on the price of the underlying. If after a certain time the underlying does not move in the favorable direction, the only possible management is to close the position in stop loss. In fact, the only way to make the option profitable would be to buy the underlying in large quantities so as to push the price upwards, exposing oneself de facto twice in the same direction of risk. Short selling offers more risk management possibilities. It can be obviously closed in stop loss, but also one we can roll towards a less risky strike. That is, we close the option initially sold at a loss, of course, and we sell 2 on a more precautionary strike. This because in order to recover the temporary loss and obtain the profit initially hoped, we must increase the exposure. Or 2, we can neutralize the risk with delta hedging, which consists in the purchase of a number of underlying contracts or shares sufficient to render the upward movements of the underlying harmless, always against a short call. In order to neutralize the short put at risk, however, the underlying must be short sold. How do you get to this result? To understand it, it is advisable to think about large numbers first. Let's say we sell short 1,000 calls on the Euro Stoxx 50 index that quotes 3,600 points, assuming it's negotiable and is worth 10 euros per point. Options are worth the same, so with one call you take control of one index. The strike of the calls is 3,800, and initially those calls have delta equal to 0.20, just to make an example. Calls sold have a 20% chance of making us lose money, at least in the beginning. But in the moment the underlying rises and reaches 3,800 points, those calls take on deltas of around 0.50 and threaten to produce a loss at maturity. And by the way, they are already producing a loss, very likely, because if from the out of the money situation they become at the money and then in the money, their price almost certainly increases. But it is perhaps only a temporary loss because everything depends on where the underlying will be at the maturity. It goes without saying, however, that during the life of the trade, risk must be managed. And this can only be done in one way if we exclude closing in stop loss or rolling. The underlying is purchased to neutralize the risk of the calls sold. The doubt, however, is how many units of the underlying to buy, and here there are two alternatives. The first would be to buy 1000 Euro Stoxx 50 indexes. In fact, any underlying is replicable with a combination of options. A long call and a short put are needed to replicate a long position. Then, the combination of 1000 short calls and 1000 long indices would be like 1000 short calls plus 1000 synthetic indexes, 1000 long calls plus 1000 short puts. And from 1000 short calls, therefore, the position would turn into 1000 puts sold, because the same short and long calls would be self-eliminated. These 1000 short calls would be self-eliminated with these 1000 long calls. And what would remain would be 1000 short puts. That's it. This practice is called static hedging or one-to-one hedging. The position at risk is completely neutralized by opening an equivalent position but with an opposite sign. The result is obviously to completely eliminate the risk in the initial direction, but also to expose oneself to a risk of the same amount in the opposite direction. Indeed, from a position initially in short call, we are now in a synthetic short put position. In the beginning, we were exposed to a price increase in the underlying. Now we are exposed to a drop in the price of the underlying. The alternative is to neutralize the risk in proportion to the probability that it can turn into an actual loss. That is to an extent equal to the delta, the probability to be in the money at maturity, which can be identified here with the optimal risk coverage ratio. Therefore, to neutralize 1000 calls sold, no more 1000 indexes are purchased, but 500 more or less. It depends on the specific delta of the option in that moment. And that 500 more or less is given by 1000 multiplied by the delta. This is called delta hedging or dynamic hedging. In doing so, the position changes radically form and also substance, because from 1000 calls sold, now we have 500 calls sold and 500 synthetic puts sold. This would lead to a strategy called short straddle, which we will see in the next lessons. How effective is this mechanism? First of all, it should be noted that the balance of the position is only instantaneous. If the underlying moves, the delta changes, and with it changes also the optimal coverage ratio. It follows that delta hedging is a very dynamic procedure. Not by chance we speak of dynamic hedging, in fact. But not only that, if the underlying rises, the coverage ratio increases, then additional indices must be purchased. But if the underlying returns back down, the hedging position must be reduced or even eliminated. Otherwise, you risk losing in the initially favorable direction. Once again, this is a very dynamic procedure. It goes without saying that a correct and constant management of the delta hedging involves a series of continuous coverage operations that are assembled and disassembled, increased and reduced. This entails operating costs that may be unsustainable for private investors, and in any case would almost certainly cancel any benefit and any expected profit. Beware of those who tell you that you can do it without problems, even on small numbers. A different, cheaper way of dealing with these situations is to apply a stepwise coverage ratio, that is to adjust the delta by steps. The value of the steps is arbitrary, of course, but with the appropriate backtesting tools, the study and patience, an optimal step of intervention can be derived. One could say, I do not intervene anytime the delta changes, but I could say I intervene anytime the delta changes by 0.10 or 0.05. For completeness, delta hedging can be done even before the option is at the money or in the money, since a minimum risk, but not zero, occurs at any time. In the example seen in previous slides, in the beginning, the delta of the short call options was 0.20. So why do not immediately purchase at 1,000 times the delta number of underlying contracts in order to neutralize the risk on the upside? You could do it, but this would make things even more complicated. A similar way of proceeding is equivalent to always operating at delta zero. That is, always remaining neutral with respect to the underlying. It goes without saying that the practice of delta zero does nothing but exacerbate the problems highlighted above. A complication in all this is when the underlying options and the contracts that can be used for hedging purposes have different multipliers. In similar situations, the optimal hedging ratio must also take into account the correct coverage ratio between contracts of different sizes. This problem, for example, occurs in the Italian market, where an option is worth 2.5 euros per point. The underlying index is worth 5, as the future is written on it, which is the tool that can be used for hedging purposes. And we will come back to this concept when we will talk about portfolio Greeks. In general, however, the problem is easily overcome by reasoning in monetary counter values of the Greeks rather than in numerical values. For now, that's all. Thank you for your attention.